All right, let's jump right in. Today we're talking about a special kind of financial tool, one that's designed to get you across one of the most stressful gaps you can imagine, the one between buying your dream home and selling your current one. This is your quick guide to bridge loans.
So picture this. You've found it. The perfect house. It has everything you've ever wanted. The only catch? You haven't sold your current place yet. Suddenly, the clock is ticking. The pressure's on. It's a classic and really stressful real estate problem.
But what if I told you there's a tool made for this exact situation, a way to confidently make an offer on that new home even before you've hammered a sold sign into your current front lawn?
And that tool is the bridge loan. Now, you might hear it called a few different things: gap financing, a swing loan, or even interim financing, but they all mean the same thing. At its core, it's a short-term loan that bridges a temporary cash gap until your main long-term funding comes through.
Okay, so how does this actually work in the real world? It's pretty interesting because it's used by everyone from regular homeowners to giant corporations. Let's break down how it works for both. For homeowners, the magic really happens with your current property. A bridge loan lets you tap into the equity you've built up, the part of the house you actually own, and use that value to make the down payment on your next home.
And here's a really key number to keep in mind: 80%. Lenders will usually only finance up to 80% of the combined value of both your old house and your new one. Why? Well, it's a safety net for them. It ensures there's enough value to cover the loan if the market suddenly dips. What that means for you is you need to have a good chunk of equity already, or have some cash on hand to cover that remaining 20%.
And because there's risk involved, lenders are pretty selective. To even get in the door, you're going to need an excellent credit score and a low debt-to-income ratio. Basically, they want to see that you're not already stretched thin and that you can handle this temporary financial juggling act.
Now let's switch gears and look at the corporate world. For a business, the problem isn't buying a new house. It's just trying to survive while waiting for a big round of investment to clear. A bridge loan can be the thing that keeps the lights on.
So what kinds of costs are we talking about? The absolute lifeblood of the company, right? Making payroll so your employees get paid, covering the rent and utilities, and paying for inventory. A bridge loan can be the lifeline that keeps a business afloat during that critical gap.
So bridge loans sound super useful, and they absolutely are. But, and this is a big but, they come with a serious trade-off. You really have to weigh the good against the bad here. Let's look at the benefits versus the very real risks. On the plus side, you get cash fast, incredibly fast. You get the power to buy your new home before you sell your old one, which is a huge advantage. And usually, you can pay the loan back early without any penalties. But the downsides, well, they're significant. We're talking high interest rates, big upfront fees, and the scariest one of all, the risk of getting stuck with 2 housing payments.
And that last point is the one you really have to think about. If your old home sits on the market for longer than you expect, you are on the hook for 2 gigantic payments every single month: your original mortgage and that new high-interest bridge loan. It's a high-wire act, and you don't want to lose your balance.
But like I said, this isn't just for individual homebuyers. To really understand the sheer scale and power of these loans, let's look at an example that takes us from a quiet suburban street to a towering skyscraper in Manhattan.
So let's go back to 2016. A huge real estate deal is brewing in New York City. A company called Olion America Corp. Wants to buy the iconic Sony building. We're talking about a massive, complex transaction that had to move quickly. And their solution? You guessed it, a bridge loan. So how did they pull off this massive deal? Well, first, they identified their target, the Sony building. Next, they secured a huge bridge loan from ING Capital with incredible speed. This allowed them to close the purchase almost immediately, locking it down. It was only after the deal was done that they went back and arranged for their more traditional long-term financing. It's a perfect example of using speed to your advantage.
Okay, so we've covered what they are, the pros, the cons, and even a skyscraper-sized example. This all boils down to one simple question: is a bridge loan actually the right move for you?
Let's just boil it all down to the absolute core ideas. 1. Bridge loans give you incredible speed and convenience. 2. That convenience comes at a cost, mainly higher interest rates. 3. You have to remember this is a short-term fix, not a long-term plan. And 4. They're used by everyone from regular families to huge corporations.
So in the end, it really comes down to this simple metaphor. A bridge loan can definitely get you across a very tricky, very stressful financial gap. The real question you have to ask yourself is, are you truly prepared to pay the toll on the other side?